is that what Singapore REITs does is that they borrow money from either banks or bondholders, bond investors, and they take this money at a very cheap borrowing cost and they invest in higher yielding assets. So higher yielding, longer term assets like properties, for instance. So the difference between what Singapore REITs pay, which is the interest cost to finance some of these properties, and what they actually collect from the rental income, this difference is the profit margin of these Singapore REITs. So if they're able to actually reduce the borrowing cost based on Fed's potential interest rate cuts here, they're able to actually have more cost savings, and if the quality REITs are able to maintain their rental income or improve their rental income, this could actually see high profit margins for many of these Singaporeans. And this is actually what is happening today if we look at some of the Singapore REITs. Now, if you look at the Fed funds interest rates or the Fed funds effective rate, so this is the interest rate, the short-term interest rate which the Federal Reserve can actually pull to control the monetary policy or the general health of the economy. You can see that over the last couple of years, Fed interest rate have actually gone up quite a substantial fair bit. So since 2022, we recall that there was this rapid increase in interest rates in order to curb the potential inflation about 2 to 3 years back. We see that Fed interest rate has actually hit quite a high point over the last 10 years, but that has since come down starting from this year. So you start to see the interest rate cut. This was despite interest rate is still remains relatively high. However, with the interest rate cut, it sort of sends a message across the Singapore REIT market that say, hey, with the potential interest rate cut, this could actually be supportive or bode well for companies or businesses which rely on borrowings to grow their business. Singapore REITs is one of them. So you can see that there's actually this general trend of declining interest rates, right? And you can see this is based according to DBS research. Very interesting here is that there are points when the difference in the REIT yields and the 10-year government yield, which is the yellow chart here, and you can see that the difference here, every time when there is a wide spread, that means an increase in the yield spread between the REIT yield. So the REIT yield is the dividend yield of Singapore REITs minus off the 10-year yield. This is the difference, or we call it yield spread. So every time when there's this yield spread, that means you are looking at low interest rates and high REIT dividend yield. This means that there's actually opportunities where you're looking at potential high dividends to actually accumulate some of these REITs. So you can see at some point between 2022 to 2023, that was actually a good time to actually look into REITs. Another time was actually somewhere between late 2024, where there was a spike in the REIT yields, the dividend yield here, versus the interest rate here, where the interest rate environment started to climb up, but the REIT yield was even higher. So that actually led to a nice yield spread. So that was also a time to actually acquire Singapore REITs. And now you start to see that this yield spread has started to go up, and it goes up really because of the potential interest rate cut. So when short-term interest rates gets cut, I think what happens is also the 10-year government bond yield will also start to drop as well. So because of the lower interest rate environment, what happened is that the yield spread will actually increase. So this is, again, it reflects an opportunity to actually start looking into some of these REITs here. Now, the second point on driving interest rates is actually also the second point on what's driving Singapore REIT performance is looking at Singapore REITs distribution per unit or the DPU. So you can see that the market is actually expecting the DPU to meaningfully go up. What this means is that Singapore REITs, they tend to be driven mostly by your rental income, right? These are all physical assets where tenants occupy a physical space and they pay a monthly rental income to the landlords. And this rental income gets distributed as your dividends to unit holders. And because with the unfolding of the COVID-19 pandemic, which we have seen a couple of years ago, we also start to see the easing of the supply chain disruption back in 2022. And of course, with a reopening of China's economy, at the same time, the US economy is also growing from the whole AI boom. What is happening is that there's this recovery in the rental income across the different properties, especially in Singapore. So we start to see retail rents starting to be more resilient. We also see industrial properties, offices starting to see the rents being meaningfully adjusted upward. That means that recall that for retail rents, for instance, retail rents tend to be very short-term leases, maybe about 3 years. The retail rent, which was being locked in a couple of years ago at a much lower rental rate, some of these are starting to see higher adjustments or more positive adjustments. That means the tenants which are renewing some of these leases, retail leases, they're renewing at a much higher market rent, especially you're looking at the Orchard Road Belt area in Singapore. You're looking at some of the residential area, especially some of the heartland malls as well. We're starting to see foot traffic coming back into some of these heartland malls. So we're starting to see this DPU expected to meaningfully climb up. So how can we actually look into, how can we determine whether this DPU can potentially go up? We actually look at two drivers. The first one is actually looking at the net property income of the REIT and also the distributable income. The distributable income is the income after you minus off the operating expense of the REIT, the interest cost of the REIT. Then, of course, this is what is left to distribute to the unit holders. So what's interesting is that this is a research report which I found very interesting by DBS Group Research. You are start to notice that what's interesting is that some of the REITs across the different sectors have started to become more positive. So if you look at offices, they tend the average net property income based on a half year change has grown about 1% compared to the half year before, which is the second half of 2024. So it's up about 1%. It has actually been pretty steady. And if you look at the distributable income, overall on the average over the last 12 months, first half of 2025, the second half of 2024, I think it has seen a more positive distributable income, more positive change in the distributable income here. So if you look at some of this performance of the rental income, the net property income, the distributable income will sort of improve. If you look at the retail space, local retail, it has sort of dipped slightly across your Fraser Centrepoint Trust, Lendlease. You can see that it was down slightly 1%, but it's just very marginal. Distributable income has sort of been more resilient. So this means that while the renewal of some of these leases in the retail space has been pretty steady, or it has sort of dipped very marginally, but what is attributing to an improvement in the distributable income is the drop in the interest cost, because distributable income is what is left after deducting the heavy operating expense, which includes your interest cost as well. The only big problem here with Singapore REITs, probably it's the overseas retail REIT. You can see CapitaLand China Trust and Cecil REIT. They saw negative rental reversion, but that is really attributing to China's retail mall outlook. Now, I was in Shanghai and Hangzhou late last month in October, and I realized like the whole retail landscape has changed a lot. More and more people are actually shopping online, and live streaming is actually a big part of the Chinese economy. So if you talk about some of the lower tier to mid-tier cities, the retail mall tends to actually struggle a bit with the foot traffic. Even though the tier 1 cities, you're talking about Beijing, Guangzhou, Shanghai, they tend to have very strong foot traffic in the central core region of the malls. Like, for instance, in Shanghai, if you're talking about your People's Park Mall, your Renmin Guangchang, for instance, those still command very high foot traffic. But if you're talking about the tier 2 cities, tier 1.5 cities, the shopping mall which are located outskirts of the suburban areas, I think those are the ones where they tend to struggle a bit. So that's where you start to see the Singapore REITs which invest in retail malls in China, they tend to actually struggle a bit. So that is actually one area or one concern which we probably want to be a bit more careful. For hospitality, is a bit more cyclical. As you can see, net property income has actually changed quite a fair bit. The second half tends to actually have a much better net property income growth largely because most of the holiday seasons occur in the second half of the year. Typically, the first half, they tend to actually struggle a bit with the hospitality REITs. But generally speaking, net property income have generally been quite resilient across the hospitality REIT in Singapore, except for the hospitals, sorry, not hospitals, the hotels and the service residences which are located in the US. I think those tend to also struggle a bit, largely because of lower occupancy rate and, of course, a more um, uh, uh, hotels and service residences which are located in the suburban areas of the US economy. So those are the ones which we have to be slightly a bit more careful, especially when we are looking at some of these streets. So you might want to actually take note of uh, what's going on with some of the overseas assets. Now, if we look into Singapore REITs, I think where we want to actually focus on are some of the local assets which we are seeing today. And also want to be a bit more careful with what's going on with the overseas markets too. So you might want to actually take note of this graph here. So this will be actually very useful in looking at the individual REITs, right? So if you look down further, if you look at industrial and healthcare, healthcare, you only have Parkway Life. Parkway Life typically tends to be more resilient, tend to be more stable, largely because the three hospitals which are under Parkway Life REIT, which includes your Gleneagle Hospital, your Parkway East Hospital, your Mount Elizabeth as well, they tend to have a rental agreement which is pegged to either the revenue of the hospitals or the CPI. So whichever is higher, this allows the rental to actually grow. So healthcare, basically, it's pretty resilient for the Singapore REIT, for Parkway Life REIT. For industrial, it's a bit mixed. I know even though the net property income and the distributable income has actually improved, but you also want to take note specific sectors. Later, I will share with you what you want to be a bit more careful with when it comes to the industrial space, the industrial REITs. But generally speaking, if you see across the board, if you look at CapitaLand Ascendas, if you look at Mapletree Industrial, if you look at AIMS APAC, Frasers Logistics Trust, the data center REITs as well, generally speaking, they tend to actually have a very nice recovery. And of course, lastly, if you look at the European focused REIT, again, Singapore REITs which own overseas assets, we just want to be a bit more careful. Why? Because number one, currency risk is one. So when some of this rental income which is collected overseas, collected in the foreign currency and converted back into the Singapore dollar, which will be used to pay out distribution, typically they'll be hit by a foreign currency risk. That's where you start to see an impact with your distribution. So we want to be a bit more careful, especially with some of the overseas REIT. But having said that, generally speaking, the distribution per unit, the distributable income and net property income generally has been starting to meaningfully climb up because of more positive rental reversions across the different sectors, as you can see here. So across the board, not all Singapore REITs are made the same. So what we want to look is to identify the individual REITs where the rental income has actually performed generally well, right? So this is where the focus on. I think, can you guys hear me? I just want to just quickly pause here. I think there are some people who are not able to actually hear me. Can you hear me? If you can hear me, please type 1 so that I know that as I'm speaking, you guys can hear me in the background. Yes, thank you very much. Thank you, Ken. Thank you, Ben. Thank you, CJ. So for those who cannot hear me, please do check your audio, do check your video as well. KW, yes, this will be a recorded. This session is recorded, but you might have to check with SGX whether they are able to publish the recorded session to you. Thank you, Kok Kyong. All right, so coming back to looking at the distributable income, this is where we actually want to focus on when we want to look at some of the REITs itself. All right, very crucial. Now, if we just dive into the different industries today, so I want to actually focus on 3 groups of industry, which is retail, commercial, and industrial property. So because this is where it makes up the bulk of the Singapore REIT market. If we actually focus really what's driving Singapore REITs today, as I mentioned earlier, number one is DPU is expected to meaningfully climb up. Now, why is this the case? Because if we look at the retail rents in Singapore, it's really driven by a recovery from the COVID-19 pandemic. we have already started to see inbound tourist flows coming from mainland China, from Indonesia as well. These are the two big markets which is driving tourist arrivals. So you start to see a lot of Orchard Road Belt malls like 313 Somerset, which is owned by Lendlease, start to see a nice recovery in the tenant sales and the foot traffic. We're also starting to see retail rents in the heartland areas, starting to see the rental income also improving. But what's also more important is the limited retail supply. So if you look at CapitaLand Integrated Commercial Trust, one of their slides, right, and this was what is interesting, and I've shared this, and I tracked this very closely, is that the forecast for the new supply in retail rent is actually very limited. So going forward, even though there's still demand for retail space in Singapore, the problem here is that the average annual supply for retail rent is actually very limited. And the new supply which is coming into the market is not exactly located in the best location, because if you look at heartland malls today, which have already been dominated by your Fraser Centre Point Trust, your CICT, these are the same retail malls which have already taken up space in very what I call very prime locations. Because if you look at the URA plan by the Singapore government, right, they have already demarcated really early on which are some of the heartland malls to be allocated. So typically the heartland malls, the existing heartland malls, right, they are already situated in a very prime location. So if you try to build new malls within the adjacent areas, right, typically this competition might not be a very strong competition, because when I talk about prime location, their location usually located near the MRT station. They are located very near residential capture, the residential areas. So this is where you want to actually focus on. So if you look at some of the malls, if you look at some of the new malls which are coming up, they typically tend to be much smaller malls. So for instance, your Marine Parade Underground Mall, Tanjong Katong Complex, so and so forth, which is located in the fringe area. They tend to actually be they are not exactly like your core malls in the prime location. Now, core malls are the core malls, right? For example, like your drone gateway hub, right? When they do the slight renovation, these are the ones where they tend to command a much higher foot traffic. So there are actually new supply coming, but the supply is actually limited. So if you talk about demand or foot traffic, local demand, they our heartland malls, they still tend to actually have very resilient tenant sales, very resilient market rents, just so because of the foot traffic. I do get like some questions with regards to, okay, with the high-speed rail, which is going to be ready in 2026, which connects both Singapore and Johor, will it actually affect the heartland malls? I think what's interesting is that I sort of observed a similar observation in Hong Kong as well, where people actually travel to Shenzhen. And the interesting thing is that for these two cities, right, typically the profile of shoppers who actually travel cross-border to do their shopping tends to be very different profiles for shoppers who shop within the heartland malls in Singapore. So what do I mean by this? So people who actually tend to actually travel to Johor, they tend to be more bargain hunters, and they tend to plan out in terms of making big purchases like on groceries, for instance. So typically these are the shoppers where they actually make plans. They actually do like maybe day trips, or maybe they stay overnight, do the shopping and then come back. But the shoppers typically, if you see in heartland malls, right, they tend to be different profile. They tend to be what I call last mile shoppers. That means shoppers or people who just finished work, they stop by the station, they do last minute shopping, and they pick off some of the items, some of the products like your groceries, for instance, your food, your dinner, from the heartland malls, then you return home. So there's actually two different profiles when it comes to foot traffic between the heartland malls here in Singapore, and of course shoppers who actually travel across to JB to Johor. And another thing, of course, if you look at Causeway Point, which is located very closely to Johor, and it's also located close to the bus interchange, which ferries people across the strait. Causeway Point actually still have one of the highest occupancy rate, and also commands one of the highest foot traffic for Fraser Centre Point Trust. So it is, despite uh, competitors across the causeway, I think so far, my take is that my observation is that the malls in Singapore, they still tend to be more resilient here, right? Thank you, CJ. CJ commented, Tanjong Katong complex is quite a large area. Depending on the tenant mix and the mall operator, it may be worth looking out. Thank you very much for that. Yeah, so if you look at some of this supply, what you want to do is to compare the REITs where the assets or the properties do have existing assets where there might be adjacent new supply which is coming to the market. But typically, my take, if you just look very carefully with some of these heartland malls, right, you just do a quick Google Map search or you just travel down, right, typically the existing heartland malls are already located in a prime location of some of these existing heartland areas. So, they already have the competitive advantage. And for REITs, by the way, if you're looking at competitive advantage, is usually the location, right? If you think about it, one example is if you look in City Hall Station, right, Raffles City Tower. Raffles City Tower is owned by CICT and it's located near the train station, prime location. But if you look at the slightly newer mall last time many years ago, the one which is diagonally across the Raffles City Tower, which owns both the hotel, which is converted to a service residence, perennial shopping mall. You can see the foot traffic is actually very, very different. All right. So again, you have to look at the prime location of some of these existing malls. Now, the next thing which I want to look at, just want to quickly share with you is the Grade A offices. Now, Grade A offices in Singapore, now when I focus on office, right, I typically want to focus on the Grade A office rent because this is where there's actually pretty much, again, limited supply, especially in Singapore, and they tend to be taken up by your multinational companies, your big corporates. And if you look at Grade A offices in Singapore, which is basically in the CBD area, the office rent also tend to be quite stable, right? And it has actually started climbing back up again. In fact, if you see, despite the work from home arrangement, right, I think what was surprising is that companies are actually starting to get people back into the office. So with this, there's actually a need for space. And despite many companies moving into a mobile-based setup, that means don't really have a fixed desk, rather a mobile desk, but there's still a need for physical space. And this has actually commanded higher office rent over the last couple of years. In 2021, Grade A office rent is roughly about $10.40 PSF. Today is roughly about $12.20. So it has actually gone up. And one thing about Grade A offices in Singapore, right, they tend to be very cyclical. Now, cyclical meaning that if you notice, right, over the last 15, 20 years, MNCs, they tend to change. Now, Grade A office rent or Grade A offices, they tend to be very stable in terms of the supply, given the limited land space in Singapore, given the limited land space in the CBD area. And this still attracts high-profile tenants. What has changed over the years is the different sectors in terms of tenants. If you recall, right, last time, different cycles, there will be a dominant tenant profile. So, for instance, it used to be the manufacturing companies, the semiconductor companies, which take up the bulk of the office rental space in Singapore. Then, of course, just before the global financial crisis happened, you have the big financial institutions, for instance. You have the consulting companies, which actually came to actually take up space. And then later on, it was the shipping companies. And then moving on, today, what we're seeing is actually a shifting of guards, meaning that there's actually a change of tenant profile more towards your technology giants, your tech companies. So your Alphabet, your Amazon, they are actually starting to take up office spaces in Singapore. Why do some of these MNCs do take up office spaces despite remote work still being in existence? Is because many of these companies, right, when they set up a shop or when they have a physical presence, they ideally want to look at places where it sort of reflects their brand and reputation, right? So Singapore being the headquarter for Southeast Asia, a lot of the big global companies still want to occupy a headquarter in Singapore, really as a reflection of their brand, as a reflection of their reputation. So it's a lot more of a status signal sometimes for many of these multinational companies, which actually have an office here in Singapore. And don't forget, right, many of these MNCs, they tend to be much larger market capitalization companies as compared to when they were back 15, 20 years before. So trying to fork out the high rental rates here in Singapore is not exactly a big problem for many of these companies. Uh, the problem, of course, is the limited supply, which we are seeing the Grade A offices. And of course, also want to be a bit more careful again with assets which own offices which are outside of the CBD area. All right, so this is actually what we want to actually look at when it comes to Grade A offices. So again, two things we are looking at: positive rental adjustments in Grade A office rent, really driven by the limited supply. As you can see, that even though new supply is actually coming up over the next couple of years, but it is still pretty much balanced between demand and supply. So when it comes to property, right, we also want to look at capital cycles. Capital cycles meaning that there will be periods where there will be high demand for a limited supply of office spaces, and there will be a period of very high supply and small demand, or stable demand but very high supply. So we want to actually look at how the balance is over this couple of years. And if you see from this slide here, right, what's interesting is that the net supply, net demand tend to be very stable for offices in Singapore. Of course, we don't want, we just want to be careful when offices, go into skyrocket rental rates, because when they're locked in at sky high rental rates, the next 3 to 5 years when they renew the leases, sometimes if the market rent drops, right, then you start to see a drop in the DPU. So we just want to be a bit more careful at the periods where some of these landlords lock in these rental rates. So if you see then the next one we want to look at is industrial properties. Now, industrial properties is quite tricky because apart from retail and commercial, industrial property across the board, they actually tend to actually have a slightly high, slightly oversupply in what you call the grade B, B1, B2 areas, where there are actually a lot more supply because there's actually a withdrawal of tenants. And all these tenants, they typically tend to be your SMEs in your manufacturing companies, your manufacturing businesses. So you start to see rentals, right? They tend to be a bit being put under pressure in this case. So especially your light industrials, which is highlighted here, you can start to see there's some pressure here in the light industrials average gross rent. All right. The one which has actually done well is the business parks. You can see here, average gross rent is actually being stable here. But the one which are under pressure is actually your logistics and your light industrials. So what's interesting is if you look at, as I was pouring through some of the quarterly results and looking at some of the latest results from the individual Singapore REITs, I think what caught my attention and what I usually use is some of the data which is by some of the blue chips. Like for instance, CapitaLand Ascendas REIT. What's interesting is that across the industrial space, the ones which are still in more resilient is actually your business parks here, your industrial and your data centers. So both the multi-user and the single user factory. So you see that the new supply, right, for business and science park, new supply is roughly about 25,000 square meters. So far, it's a small percentage of the existing supply, but so far there's no pre-commitment to the leases yet. So this is one area which we might just want to be a bit more careful. If you look at the industrial and data centers, new supply roughly about 2.2 million of new supply, but you can see 74% of these leases have already been pre-committed. Pre-committed means that before this new supply gets ready, or TOP, there are actually new tenants which are actually coming in already. Same goes for logistics and distribution center. So industrial is, again, we just want to be a bit more specific. We just want to look at areas like data centers, for instance. We want to look at your multi-user, single-user factories, a specific location where the tenancy is still high, the occupancy rate is still high, and look at look at the REITs where they are seeing positive rental adjustments. So if you look at REITs, like for instance, your AIMS APAC REIT, where they own many of the single user, multi-user ramp-ups assets, logistics and warehouses, they actually have experienced a positive rental adjustment. So these are the REITs or the industrial REITs you want to actually take note of, right? Okay, so these are the three sectors where if you look at again what's driving Singapore REIT performance, and going forward, what are some of the key drivers that could potentially sustain the performance of Singapore REITs. If you look at the three main sectors: industrial, offices, Grade A offices, which is your CBD offices, and your retail, you can see that the demand and supply is pretty much balanced. So this actually gives rise to uh, um, a more stable demand and making a more defensive kind of rental adjustments going forward. So having said that, if you look, what's interesting and what's an interesting observation is that typically when REITs also start to, if you see in a more optimistic sector outlook, right, REITs, they tend to be more aggressive in their acquisitions. So property acquisition is also expected to boost your distributable income. So a couple of things to note, REITs like CapitaLand Asset Trust, they have recently acquired 2 freehold hotels in Japan. Five Hospitality Trust also, they have been aggressively acquiring properties in Japan. If you look at Fraser Centrepoint Trust, they have already acquired the North Point City's the South Wing. So this is actually a $1.1 billion project. The purchase price, they got it about 1.17 billion. Digital Core, which previously, if you recall, they actually pulled back on acquisitions because of the high interest rate environment, but now they're also starting to go back into acquisition mode. So based on these observations, right, you sort of can tell management's sense on the interest rate environment, because when they're starting to acquire properties, right, they are basically taking advantage of the potential low interest rate or low interest cost first. They are actually locking in the interest cost here. At the same time, they're also locking in a potential higher rental yield or rental income. So this is actually one observation. And if you compare to last couple of years, the acquisition market has started to heating up as well. So this is also another observation, and it's also one sign or one driver of the performance of Singapore REITs, right? So if you look at some of these, right, looking at Fed interest rate cut, if you're looking at the DPU expected to meaningfully climb up because of a much more positive outlook on across the different sectors, and on top of that, a more buoyant property acquisition market this year and potentially next year. What are some of the key risks which we also want to look out for? Couple of things here is to look at the occupancy rate. So if you track back the different cycles for Singapore REITs, typically Singapore REITs tend to be more resilient when it comes to cycles, especially for the high quality REITs, for instance, where they own Grade A offices, retail assets where it's located in a prime location. If you just look at some of the data here, right, from peak to trough, typically for Singapore offices, they tend to actually be more resilient. So occupancy rate is something which I do track very closely. You also want to take note of it. On average, if you see the peak to trough, right, peak to bottom, typically during a financial crisis, it hasn't really changed that much, especially during the COVID-19 pandemic. Offices only dropped overall, right, dropped about 3%. So the average is down about 7%. Retail also tend to be more resilient across the different crises: Asian financial crisis, .com, global financial crisis, the COVID-19 pandemic. So we have actually tabulated some of these data based on the Singapore REITs occupancy rate. They tend to be more resilient. Industrial as well. So what this means is that if you look at Singapore REITs, first of all, we want to actually identify the weaker ones and the stronger REITs. So the stronger REITs, they tend to command a much stronger occupancy rate. Why is this the case? Is that some of these landlords, they have the financial power to help tenants, let's say, defray rental costs, subsidize rental costs, push back rental costs during this crisis. So they can actually do that. Number two, some of these REITs, they are able to actually control their borrowing costs during some of these financial crises. So because of this, right, they are able to retain the tenants by introducing subsidies, for instance, delaying the rental income. So these are able to actually lock in these tenants. So that's why the occupancy rate, they tend to be more resilient. So what's important is to actually maintain the tenancy rate, the tenants. Why? Because if you see, if there's actually a change in tenants, right, typically there will be a slight vacancy for a few months, and this could actually impact rental income. So the high quality landlords or the high quality Singapore REITs, they actually tend to have very strong occupancy. So if you look at office, retail, and industrial, um, hopefully this gives you a good ballpark or benchmark. So you might want to actually have a screenshot or take note of this. So this gives you a good idea when you actually look into your individual Singapore REIT positions, or if you are actually assessing some of the individual REITs, you can compare and contrast the current occupancy rate with respect to some of during the crisis, what is the peak, what's the bottom, right? So this is actually a very, very useful chart. I'd just like to share with you guys as well. Now, another thing which I also want to talk about, right, is when it comes to Singapore REIT cycles, if you track interest rate movement, what typically happens is that in periods of high interest rates, it tends to actually affect Singapore REITs and their DPU, and at the same time also the Singapore REITs performance. Of course, when the yield starts to drop, this is actually a positive for Singapore REITs. So you can see Singapore REITs, the plus sign, the DPU plus, this is actually positive. So you can see here, yield was flat here, 2012 to 2013, or it was on a declining trend. The blue line is the Singapore 10-year bond yield. You can see that there's actually a upcycle in terms of the DPU and the Singapore REIT performance. So same thing happened again 2014, 2015, 2017, 2018. So these are actually cycles, Singapore REIT performance versus the Singapore 10-year government bond yield. And typically in a period of lower interest rate, when there's an inflection point or change in interest rate cycles, we also start to see an inflection point in the DPU of some of these Singapore REITs. All right. So what are some of the critical signals to watch for? 4 big points. You might want to take note of this. Number one, Fed's interest rate cut. So potential interest rate cuts, as interest rate cuts continues to follow a downward trend, this will actually support Singapore REIT performance. At the same time, also the profit margins of Singapore REITs. Any surprises in interest rate change, right? Let's say if the Fed decide to pull back interest rate cut or delay interest rate cut, this could be a negative for Singapore REIT. So you might want to take note. Having said that, you might want to diversify your portfolio in your Singapore REITs for your Singapore REITs position to hedge or protect against any surprises. Second thing, rental reversions. When you're looking at some of the quarterly updates, the business updates for Singapore REITs, or more important, the half-yearly update and the end-of-year updates, look at the rental reversions, the rental adjustments. Have the rental adjustments meaningfully improved? That's one. Number two, look at both the DPU and the net property income. Has the net property grown, which reflects growing rental income? Has the DPU maintained or actually grow? Means that even though rental income grow, we also want to make sure that the REIT did not raise a lot more shares or sell more shares or raise equity, because that could dilute the DPU. Number three is the occupancy rate. Have occupancy rate actually been stable, and has it been better than the average occupancy rate across the respective industries? And lastly, consumption spending. So I usually look consumption spending, very simple. Look at tourist arrivals, for instance. That's one, and also looking at inflationary pressure. So more stable inflation in Singapore would give rise to a more stable growth in rental income. Why? Because a lot of the retail rents, they tend to actually peg both to the revenue of the tenants, and some of them also to the CPI. So growing CPI, which reflects more consumption spending, is also one critical signal to actually watch for. So these are the 4 big points. Now, if you just want a quick and dirty look at Singapore REITs and you're looking at this by yourself, these are the 4 things which I will actually look out for. All right. Now, then of course, if you look at today's valuations, with the recent the recent performance in Singapore REITs, then are there still opportunities looking into Singapore REITs, because if you look at the average price to book ratio, it's actually started to go back up to average 1 time. The index dividend yield has also sort of compressed to about close to 5%. So I have been sharing a lot on Singapore REITs with SGX over the last 2 years, 2 to 3 years, and I've actually watched how the long-term price to book and the distribution yield has actually traded. There are actually periods of time where there are really great opportunities, which I actually shared with you guys previously before. Today, maybe the opportunities have sort of narrowed, but there are actually still very interesting ideas out there which you can actually take a look. And I also want to share with you today one very simple case study, a Singapore blue chip REIT, which is trading at about 6.5%. So this particular REIT is an industrial property which I like. And for disclaimer, I do own Mapletree Industrial Trust. Recently, it was down over the past year, down about 11-12%. Why was it down? It's largely because Mapletree Industrial Trust has now evolved into a data center landlord, right? So almost half of their portfolio is actually in data centers and in the US. And we know that at the start of this year, there's a lot of volatility in the market because of the launch of DeepSeek in China. You have also the tariffs, the chip restrictions by the US government into China as well. So this has actually affected semiconductor companies, chip makers, at the same time, the peripherals of the AI sector, which is your data centers. So data centers is actually quite big, substantial in Mapletree Industrial Trust, and as a result of this sector impact with geopolitical tensions, it has also affected the performance of MIT. So if you see, MIT has actually evolved quite a fair bit. What's interesting that they used to be traditional industrial property landlords, but today half of their properties are in data centers, mostly in the US. What's interesting is that their DPU has actually gradually grown over the years, and this is the reason why I like Mapletree Industrial Trust. I like their assets, but we have to actually make sure that we actually acquire them at the right price, right? So industrial properties, you want to be compensated for a much higher dividend yield, because don't forget, right? Half of Mapletree industrial assets are still in the traditional industrial property space, which means that for industrial properties, they tend to have much shorter leases. When the leases expire, some of these assets will have to be renewed, or they have to be renewed at a cost. So when Mapletree Industrial Trust, for instance, when they have to renew some of these leases, right, to extend the leases, what they typically need to do is they will probably have to cough out some money to renew the leases. So this is when they actually have to do rights issue. So the high dividend yield is a way to compensate for the potential future rights issue which may have to be made to extend some of these traditional industrial leases in the traditional industrial space. But having said that, the distribution yield has actually been growing steadily over time. Again, what's interesting, you can see borrowing costs have actually gone down as a result of lower interest costs. They also have repaid their borrowings as well. But at the same time, gross revenue and net property income has actually dropped because they have actually recently divested some of their industrial properties in Singapore. But at the same time, because of the volatility and geopolitical tensions, we see that the US dollar has also weakened over the last couple of months against the Singapore dollar. So currency risk is also one impact on the gross revenue. But having said that, if you see for the DPU, it has also sort of fell marginally in terms of on a half year basis. So I think that's where, but despite the drop, if you look at the last 12 months distribution, right? If you just take the last 12 months distribution per unit, divide by the current share price, Mapletree Industrial Trust is still trading about 6.5%. One thing which I like is they still have a very strong balance sheet. So aggregate leverage is still roughly about 37%. Borrowing cost right now is it has sort of remained stable and improved very slightly, about 3%. And it's still a very high quality Singapore REIT with a BBB plus rating. So if you look at credit rating, I think this is a very, very strong industrial landlord. So what I'm concerned with Mapletree Industrial Trust, okay, one thing which I'm concerned, of course, is the refinancing. So refinancing coming the next 2 years they will actually have roughly about 1/3 of their loans being refinanced, or slightly 1/3. So if let's say, if the Fed delays interest rate cuts, they might still have to actually refinance at a slightly high interest rate. So this is actually one risk or one concern which we have to actually note when it comes to Mapletree Industrial Trust. But other than that, I think in terms of the assets, I think it's pretty high quality. If you look at it, I still like it at about 6.5%. In fact, 6.5% is actually a pretty good yield. Now, when will I not buy Mapletree Industrial Trust is when the yield was trading at about 3 to 4%. I think that is actually one of the worst time to actually accumulate Mapletree Industrial Trust, because that's the point where the shares trade at one of the historical low dividend yield. All right. So this is one of the ideas or opportunities which I sort of shared with you, just looking from top down, looking at the macroeconomic point of view, looking into different sectors in the industrial space, especially that there are actually still blue chips which are trading at about 6.5%. And I think that Mapletree Industrial Trust, if you look at it as a case study, I think this is one blue chip REIT where it's actually worth looking at, right? So with that, I'll come to the end of this webinar. I'll also take questions as well. Of course, if you want to actually look into what are some of the other REITs which I'm looking at, feel free to actually get my 10 best Singapore REITs to buy. So if you are getting your feet wet into Singapore REITs, you just want to get started, you know that you want to know what's going on, and if you just want to find out a bit more about the history of some of these REITs, I've actually written a ultimate beginner's guide. Simply scan the QR code, and I'll have this guide actually delivered into your inbox. So do actually check it out. By the way, Mapletree Industrial Trust is also one of my 10 best Singapore REITs to buy in this special guide as well. So with that, I've come to the end of my webinar. I will check out the pigeonhole. If you have any questions, do feel free to type in the pigeonhole. Again, if you if you want to stay, if you want to get regular updates, you want to stay informed with what's going on with the market news, SGS Group also provide very regular updates as well. And for me, I personally look at some of the data which is provided by the SGX, so very, very useful. If you have any questions, definitely feel free to scan the pigeonhole here. Type in the passcode, and I'll shortly answer some of the questions which you guys might have. All right. So I'm just looking at some of the questions. Do make sure you type into the pigeonhole, so I'll actually look into some of those questions. Okay, CJ asked about commented about if most tenants are leased to government-related tenant, yeah, then PLQ more will still be good. Land lease REIT, yeah. So if you look at land lease, I think it's to me personally, it's still one of the more high quality REITs. I mean, we look at 303 Somerset, PLQ as well, and recently they have also looked to actually acquire PLQ shopping mall as well. CJ asked, MINT, which is Mapletree Industrial Trust, is one of the worst performing S-REIT year to date. Why? Again, like I've earlier mentioned, it's really because of the trade war which happened earlier this year. Also, the launch of DeepSeek, which sort of shook the AI sector, and at the same time, because of the geopolitical tensions, which had a lot of the chip restrictions between US and China. So that has actually affected some of the AI related sectors and also the data centers as well, the peripheral sectors. So because of that, I think that has also sent a lot of stocks like MIT shares actually struggling. So this is also one of the reasons why. W asks, Mapletree Industrial Trust data centers in the US are older and not suitable for AI workloads. How do you view this issue affecting the REIT's performance? So I'm not very sure what is the percentage of Mapletree Industrial Trust data centers being old and not suitable for AI workloads. I don't really have that number, but what I can say is that a lot of Mapletree Industrial Trust data centers are actually located in the core regions of the popular areas where a lot of tech companies reside. So you're talking about the North Virginia area, for instance. Silicon Valley is also another place. These are areas where the data centers are actually in close proximity, and they tend to actually command the highest rent, right? Because they're actually close to the hyperscalers, they're close to the tech companies. But increasingly, because of a lack of data center supply, actually a lot of the data center operators, they actually move out to the suburban areas where the rents are actually much cheaper. So MINT, I think what they have is actually the prime location, right? And in terms of AI workload suitability, I think once typically these hyperscalers, when they actually take up space for data centers, right, they already have some of these technology being servers and equipments being fitted into the data centers. Otherwise, they actually have to do some AI or some renovation. So I don't think this is actually a big impact. And again, I know I'm not sure what is the percentage of Mapletree Industrial Trust data centers which are much older and not suitable for AI workload. I don't think this will be a very, very big impact overall. And how do I see this? Look at the occupancy rate, look at the rental income. Stefan asked any comments on the potential combination between CapitaLand and Mapletree. So far, I know there has been talks about it. I mean, when they start to talk, when media starts to talk about this, sometimes it's just, a lot of it's just rumor speculation. It's very, very difficult to actually put a timeline. But what I would say is that if it does happen, typically what I'll look at as a unit holder is I want to look at what are some of the portfolio, the assets which are being included. That's one. How will the merger and acquisition be financed? That's also another one as well. Typically, it's in the future, it's actually good for the REIT because you can actually reduce the financing cost. But at the same time, it also allows Singapore REITs to actually more meaningfully compete against overseas operators. Why? Because if you realize, right, property market is actually a very intense competition. You're competing for some of the best, well-located assets, and these are typically already acquired by the big players like Blackstone, KKR, Brookfield, which is in Canada as well. So these are the big property operators. So in order to compete with them, you need to have of a certain size. CJ asks, can you share why Capital DC REIT share price is not doing as well expected despite higher rental reversion? So in the short term, I think it's the same problem with Mapletree Industrial Trust is really because of the recent volatility in the tech sector. Again, when China launched DeepSeek earlier this year, plus the tariff war, that has affected the tech stocks and the peripherals of the tech sector, which also includes your data centers. Can you show the slide on peak and trough occupancy rates again? Yeah, sure. All right. So I'll just leave it here for a while I answer the other questions again. GP asks, do you think the Singapore REITs in general are on the up or down trend over the next 1-2 years? Should we wait for price to drop further down to nearer to support level price for us to buy at a good price? Very good question. Now, I cannot predict exactly where the Singapore REIT index will actually go. But what I can say is that going forward, if the Fed continues to drop interest rates or cut interest rates, my expectation is that the profit margin for Singapore REITs will start to expand. Why? Because you have cheaper financing costs. By the same time, I'm expecting the DPU to meaningfully climb out. As you can see from a tighter supply space in Singapore and a more healthy rental adjustment, more positive rental adjustment. But this only applies mostly to the local assets in Singapore REITs. Because if you see earlier, right, in one of my charts, I didn't show you that the overseas assets owned by Singapore REITs isn't doing very well. So it's very country specific for Singapore REITs. Now, should we wait for price to drop further? For me personally, it's very, very difficult to fish the bottom. What I'll try to do is I will try to time the market by trying to identify the REITs dividend yield. When they're trading at a historical high dividend yield, when they're trading at close to a historical high dividend yield, that's where I want to more actively accumulate the shares. I want to slow down my accumulation when the Singapore REITs dividend yield are trading at close to a historical low dividend yield. So that should give you some idea or signal on when to actually acquire or buy Singapore REITs. Okay. Okay, I'm looking at some of the other questions now. Okay, how does online shopping trend affect retail REITs? Very good question. So if you look at retail REITs here, now if we see retail REITs, right, we always have the fear that online e-commerce trends will actually impact brick and mortar stores, which is true to a certain extent. But if you think about it, over the last 20 years, right, online shopping has been around. Okay, not last 20 years, maybe the last 10 years, online shopping has been around. But if you notice some of the retail REITs, rental still have been very resilient. Why? Because again, there are two different classes of shoppers. People who shop online for convenience, people who shop last mile for last mile delivery. Orchard Road Belt retail assets, they tend to actually attract the tourists. So tourists want to come to Singapore, they typically they don't come to Singapore to buy things online. They come to shop along Orchard Road for the experience. So online shopping, you know, for the most part, if you have the fear of online shopping disrupting brick and mortar stores, it has already been disrupted over the last 10 to 15 years. Going forward, I think what a lot of the retail REITs are doing, they're actually trying to change the tenant mix, right? So it has already impacted it. What we can see now is really a change in different tenants, the different tenant mix. So more experienced type of retail, more experience, more food and beverages. And even though if you see like, for instance, Singapore the F&B has sort of keep closing down, right? But it has been replaced by new tenants. The number of F&B outlets have actually been growing despite the fact that more and more local Singapore F&B outlets have been shutting down. So it's a lot like what I mentioned on Grade A offices. Grade A offices, tenants tend to be very cyclical, but what what is resilient is that these tenants continue to actually take up space in Singapore, right? Just so because of the prime location. Right, I hope that answers your question. Let's take a look at another one. Hi, can you share why is business park space not in demand anymore? High vacancy rate versus Grade A offices doing better. Now, I think this is very hard to compare. Business parks, they tend to actually be in the fringe area, the suburban areas. And a lot of these, some of these business park space, right, if you think about it, a lot of the operations are usually what I call your back office operations, your IT services, your back office operations, like your administrative issues. And a lot of these functions are gradually being outsourced outside Singapore. It's a lot like how the manufacturing companies have been outsourced outside of Singapore over the years. So it's the same thing which is happening for a lot of the back office spaces to save cost. So if you compare this to Grade A offices, Grade A offices are a bit different. Grade A offices are usually taken up by companies where their department are more revenue generating. And at the same time, they actually take up space in the CBD area for a different reason. Number one, social status. Number two, reputation, right? So there's actually a difference in terms of the buyer's profile when it comes to taking up space in Grade A offices. So one thing would change is the different tenant mix, right, over the years, shipping, IT, financials. But what remains constant in CBD is the supply, right? You can't really increase the supply in our CBD region anymore. Thank you very much for the question. The next question I get is any difference in the potential of different types of data centers, hyperscalers, co-location? Okay, so these are just basically different definitions, meaning that hyperscalers are basically companies like Microsoft, Amazon, which owns their own data centers, which is obviously not enough because these tech companies, they're not going to put in resources to build data centers. That is not their forte. Their forte is actually moving into what they do best, which is selling their products and services. That's why even though you have big hyperscalers taking up their own data centers, it's not going to crowd out third-party operators, data center operators. Co-location basically is just a definition where you basically share data centers with other tenants. This usually it might not be very common because sometimes data centers can be quite sensitive, and tenants might not want to share information or share physical spaces with other companies, right? But overall, the demand for data centers is still there because there's still like a lack of data centers. And data centers are very sensitive to location, proximity, especially near to power supplies, for instance, near to hyperscalers, near to some of the tech companies. Okay, I hope that answers your question. Okay, okay, CJ comment, online shopping would affect only certain type of tenants. Hence, you will notice more and more malls are opening up more F&B, which is not really affected by online shopping. But the problem is the mall will look deserted during normal time. So successful mall has to balance that. So yes, it's true. For malls, it moves in cycles even during the day itself. There'll be some periods where the malls are always packed, some are not, right? So the malls at times where it's always packed, they will usually account for the bulk of the revenues. Again, you have to see the prime locations. For retail malls, again, we want to look at what we want to really focus on is to focus on what is actually the prime locations of some of these malls, whether it's in the Orchard Road area or in heartland areas. All right. Okay, that's it. I guess that's all I have. Thank you so much for the wonderful questions tonight. I really appreciate it that you have shared with me some of your questions. I think this has been really, really helpful. If you want to actually, if you want to get started, investing in Singapore REITs, you want to find out what are some of the REITs as a beginner, you just want to get your feet wet, then do download my 10 best Singapore REITs to buy, the ultimate beginner's guide. So I write, me and my team has actually write this and update this. We try to update it every year. And this will be a very useful tool for you to get started investing in the Singapore REITs market. So with that, thank you very, very much for your time tonight. I hope this has answered your questions. If you want to find out more about what I write, you want to find out more some of the other ideas as well, you can always go to dividendtitan.com. So that's where the blog where I regularly write on the Singapore market as well. So thank you very much. I hope you have a very good evening. Thank you, Kelvin. Thank you, Tenny. Thank you, Stephen. Thank you, DC. Thank you, Sabrina. I think you guys have been really a joy to actually share some of what I have to share with you tonight. So with that, thank you so much.